Alrighty, everybody, what is going on? Welcome back to another CYPRX video breakdown. In today's video, I want to talk about something that doesn't get enough attention in crypto, and that's why learning fundamentals and technical analysis is critical for long-term survival. Too many people come into this space chasing hype, they follow influencers, and they hope for quick wins, and most of them don't end up actually lasting. Markets tend to change, narratives change, sentiment flips, but when you understand why price moves and how it moves, you stop reacting emotionally and you start making informed decisions. So, today I'm going to break down how fundamentals help you read the bigger picture. We're going to be diving through the rabbit hole, going over one of our lessons inside the private CyberX Discord that we give to the community members. And we're showing you all in real time that this is working. There is something in the water in the CyberX community because as of recent, we had 4 private members pass fully funded challenges, and it is only February 4th. That is one funded CyberX member per day. You guys can see here. I'll maybe read through some of these posts here in just a second, but Grow Your Vibes inside the private CyberX Discord said today finally passed the account after 1 year. Couldn't pass before. Just wanted to say thank you to this community, especially Institutional Scalper and myself, C. Demanencore, for the support and knowledge that you provide. It's unprecedented. As we continue, we also had Lee CUK pass a challenge today, making over 10,000 rigging in his trade today. This is so phenomenal to see. We also had DeFi Crusader, and we also had one of the CyberX OGs, Melaine, go on to post a challenge. Now, I was lucky enough to actually attend Elaine's wedding back last year at the beginning of 2025. So it was just so phenomenal to see that I've been able to engage in person with some of these members and now seeing them fully prosper in our community because of some of the things that we discuss and talk about. So we're going to dive into one of those lessons today. But first, I want to show you guys that retail articles and fundamentals are always catching up to us here at CyberX to show you guys how powerful being a part of a community that is ahead of the curve, that actually gives valuable fundamental and technical analysis information before it happens, how critical it is. So this is a fundamental piece from FX Street. It's almost like somebody, honest to God, that types out FX Street articles is inside the private CyberX community. You guys can see the date here at the top. It's February 4th, 2026. And it says, crypto today, Bitcoin, Ethereum, XRP tick up despite macro uncertainty and retail exodus. And down here, it goes on to talk about some of the macro uncertainty that is lingering in the background that has weighed recently on crypto prices. Fed reforms trigger macro uncertainty as crypto prices wobble. Global markets continue to face macroeconomic uncertainty amid the Federal Reserve reforms, right after the United States Central Bank maintained its target interest rate. Back on January 28th, President Donald Trump nominated Kevin Warsh to succeed Jerome Powell as the next Fed chair. Market participants are reassessing Warsh's previous hawkish stances as Fed governor, which is resulting in instability and a sharp sell-off across precious metals such as gold, silver, and as well as digital assets. But then the information stops there. And that's it. And that's all that retail articles give you guys. So I want to break this down a little bit more in detail, why this is weighing on market sentiment. One of the major factors, because it's not the only one. There are multiple different factors, which we've covered in previous video breakdowns. But as my follower and my viewers here at CyberX, I want to really inform and educate you guys and just show you all the power of this community. Now, showing that our private community members are indeed passing challenges and becoming fully funded, active day traders in the market. Let's put that aside. This is to show you guys that the knowledge and the fundamental awareness and the breakdowns that we give in this community are paying off in real time. So last night we had a full-on fundamental breakdown going over this whole entire Fed debacle. And so I want to read that lesson for you guys in detail. I started the lesson yesterday. Again, mind you, I tried to show you guys the retail article just now. This is our lesson from yesterday, Tuesday, February 3rd. Starting here, said, are you all ready to break this Fed thing down? So asking the question, I'm just going to read my personal commentary to go through the lesson for you guys. Make sure that you all are paying attention, take some notes, rewatch this, and then again, understand that inside the private CyPRX community, these are the things that we talk about every single day on private Zoom calls and our fundamental reports in each of our channels, keeping our members updated. If you want to be a part of a like-minded community that is actually here to provide you all with value, real education, and real information that keeps you in the loop with what's happening in global markets, not just in crypto, but also in equities, commodities, FX, then tap in with us in 2026. Starting here, I go on to say, why do stocks and crypto usually struggle when money gets tighter? Think of it like this: when money is tight, there's fewer loans, less leverage, less speculation, less investment, so prices tend to fall. But ask yourself this question: if the Fed's recently cut rates 3 times and are assumed to continue to cut rates again 2 times this year, why are prices down right now? Right? When you see the headline, then it's like rate cuts right on Whale Watchers, or I don't know, what's another one out there? One of those large Twitter handles, Watcher Guru, and then like rate cuts, market pump imminent, something like that, right? Ask yourself, why is the market down? Okay. Well, to answer this question, you need to answer another question. When it comes to fundamentals that move the market sentiment, do markets move on facts or on expectations? Most of our members responded back by saying expectations. That is correct. Markets mostly move on expectations. By the time something becomes a fact, what you will notice is it's usually already priced in. Smart money positions itself before the event, especially ahead of retail. So, what matters more, rate cuts or how much money the Fed puts into the system? Think of a rate cut headline as the distraction. Behind the curtains, you want to look at the actual balance sheet. Is it contracting or expanding? Or should I say, expected to expand or contract? Can anyone tell me, what does price equals future expectations mean? Don't overthink it. Iron Man went on to say, what the price of an asset will be in the future as his answer. I checked that off because that is correct. Iron Man said it perfect. Keep in mind, big players are always planning months ahead. It simply means today's price tends to reflect what investors believe will happen later. So, read this. This is from yesterday, Reuters, February 3rd. Investors are ramping up bets on higher long dated treasury yields and steeper yield curve as incoming Federal Reserve Chair Kevin Warsh is expected to press for interest rate cuts while shrinking the U.S. central bank's balance sheet. Warsh's preference for a materially smaller Fed balance sheet, currently around 6.59 trillion, implies a withdrawal of meaningful government demand for treasuries, a move which tightens financial conditions because the central bank is not providing liquidity to the market. Again, I repeat, because the central bank is not providing liquidity to the market. Reduced Fed bond reinvestments and purchases expand the amount of treasury supply in the market, which tends to lift long dated yields, steepening the curve. The main outcome of the shrinking balance sheet would be to have a yield curve that is more normally positively sloped, as it was historically before all the intervention following the financial crisis. Now, with that in mind, coming back to the lesson, I said the yellow highlighted parts are key. Now read this. US rate futures show traders still expect roughly 2/4 percentage point rate cuts this year, with the first happening at the June 16th to 17th meeting, reflecting confidence a Warsh led Fed will focus on normalizing borrowing costs. And I asked the question, now this article would confuse retail traders. What part do you think would confuse retail traders who don't understand what we just discussed above? Pause this video, reread that statement, and answer the question if you can. Hint, I said, it is one single sentence. John replied back and said, 2/4 percentage point rate cuts this year, with the first happening June 16th through the 17th, is something that would most likely confuse retail traders that are presumed to think that rate cuts automatically mean stimulus, quantitative easing, injections into the money supply, and so on and so forth, and prices go parabolic. I said back to John, perfect. So outside of all the other BS that is going on, like geopolitics and tariffs, why are the markets risk off right now? if nothing happened yet. And Julian replied back with the best response. Again, don't overthink it because price equals future expectations. Julian said it best because investors are preparing. They think better safe now than sorry later. So they move to things like cash, bonds, defensive assets like gold, silver, safe havens before trouble arrives. So let's break this down. I told the members to give me a thumbs up when you all are tracking and reading the paragraphs that I'm writing. Starting off, financial markets are forward looking. They don't wait for policies to happen, they react to what they expect might happen next. That is exactly what we are seeing right now with the growing focus on Kevin Warsh potentially leading the Federal Reserve. Even though no major policy changes have been implemented yet, investors are already adjusting their positioning. This is why, or at least one of the reasons why, risk assets such as stocks and crypto and other growth focused investments are facing sell pressure. At least one of the reasons, as I mentioned in our lesson. One of the biggest concerns in the market is Warsh's preference for shrinking the Fed's balance sheet. In simple terms, this means the central bank would be pulling money out of the financial system instead of putting it in. When the Fed reduces its bond holdings, it stops supporting the bond market the way it has in recent years. More government debt must then be absorbed by private investors, which tends to push interest rates higher, and at the same time, there is less overall liquidity circulating in the economy. Risk assets, we know, depend heavily on easy monetary policy and strong liquidity conditions. So when that support looks likely to fade, investors become more cautious. Okay. And again, our private members are saying this is intense. This is such a great lesson. Let's continue. So we need to understand shrinking the balance sheet also puts upward pressure on long term interest rates, which tends to affect everything from mortgages to business loans and corporate financing. When long term rates rise, companies have to pay more to grow. Consumers tend to spend less, and investors demand higher returns to justify taking risk. As bonds become more attractive due to higher yields, money naturally rotates away from stocks and crypto and towards the safer haven assets. This shift puts additional pressure on risk markets and limits upside momentum, which is exactly one of the primary reasons why we have seen a global sell off in risk assets over the past consecutive couple of months. Another issue is the conflicting signals coming from potential policy direction. Warsh has recently sounded more open to short term rate cuts, aligning in some ways with expectations from Donald Trump for easier financial conditions. On the surface, lower rates are usually positive for markets, right? And that was a trick question because that is wrong. That is exactly what the retail headlines want you to think. Remember, cutting rates while shrinking the balance sheet sends mixed messages. It's like pressing the gas pedal and the brake at the same time. Short term rates may fall, but long term rates can still rise because of reduced bond support. This creates confusion about whether policy is truly supportive or restrictive, and markets tend to pull back when direction is unclear. Remember, I've always told you guys, all risk assets do not like uncertainty. Write that down. You see that word in global headlines, uncertainty, and it usually tends to reflect a broader sell off or sell pressure or consolidation in risk assets. Mark my words. So, why do markets hate mixed signals? Think like a large investor. DeFi Crusader said it best, who was actually one of our most recent profitable traders. As you guys can see here, DeFi Crusader was one of the members that just passed his funded challenge. So he is paying very close attention to the information that we give inside the private CYPRX community, and it shows. He responded back to this question: why do markets hate mixed signals? Think like a large investor by responding and saying uncertainty. Again, don't overthink it. DeFi Crusader said it best: never overthink it, because large investors need clarity to commit capital. If direction is unclear, what do they tend to do? They protect themselves first. Always remember this: confused markets usually tend to equate to defensive markets. So, to continue, even though these policies have not fully been put in place yet, Fed Warsh has not been voted into office or into the Fed chair yet, and he's not made any policy decisions. Markets are already pricing in the possibility that they will be in the future. Investors do not wait for confirmation, they prepare in advance. The expectation of declining liquidity, elevated long term rates, and more restrictive conditions in the future is enough to create a risk off environment today. This is why money is moving more defensively and why speculative assets are struggling to gain traction. Outside of course, all the other things weighing on market sentiment, like the geopolitical tariffs, the tariff uncertainty, the Russia, Ukraine, the Iran debacle with the United States right now, and obviously, of course, the data that we've seen from the United States pushing back on rate cuts. Now, we have to also think Powell was a very straightforward Fed chair, believe it or not. Most people didn't agree with him, so on and so forth, but he was very straightforward for the most part. Warsh, however, is giving mixed signals. Remember what I said before, mixed signals equal uncertainty, and markets do not like uncertainty. During Powell's leadership, markets developed a clear understanding of how the Fed would respond to economic stress. Investors knew when to expect easing, pauses, or tightening. Now we are about to transition. And with Warsh, that framework is less established. His shift from previously hawkish views to more dovish tones has made his long term approach harder to predict, and the lack of clarity increases perceived risk. So, concerns about higher volatility are also weighing on sentiment. Warsh is viewed by some as more willing to challenge traditional Fed thinking, which raises the possibility of policy surprises. When investors expect more frequent or sudden changes, they become more cautious. This leads to higher market swings, reduced leverage, and lower speculative activity, all of which tend to hurt risk assets. Few more minutes of your time. With all of that in mind, now that you guys understand the current sentiment, what could turn sentiment around surrounding the Warsh situation? Very plain and simple. For sentiment to turn more positive under a Warsh led Fed, several conditions would need to improve. The balance sheet would need to be managed carefully, with clear signals that liquidity will not be drained too aggressively. Currently, that is what the markets are pricing in. Markets would need signs that that's not going to happen. Long term interest rates would need to fall, indicating easier financial conditions. Rate cuts would need to translate into generally cheaper borrowing costs across the economy, not just on paper. And Warsh would also need to establish consistent and predictable communication so markets can trust the policy direction. At the same time, inflation would also need to remain under control, giving the Fed room to support growth without being forced back into a tightening cycle. So, hopefully, you guys enjoyed that. My goal with this lesson and the lesson for the CYPRX superior traders inside our private CYPRX Discord was to get you all to see through the retail hype and understand the Wizard of Oz behind the curtains. Not to predict what is going to happen next, but to show you all in the end, risk assets are reacting negatively not because of what has already happened, but because of what may happen. Investors are worried about tighter liquidity, higher long term rates, mixed policy signals, and rising volatility. Until there is clear evidence that financial conditions will remain supportive, markets are likely to stay cautious for now. However, if liquidity improves, rates fall, and policy becomes more stable, sentiment can shift relatively quickly. Until then, risk assets will likely remain under pressure. If you all want some book recommendations that helped me learn about the monetary policy system, I gave a few in the chat for our private community members. And then obviously, of course, love and light. If I know that I aim high, I know you all as well. And then boom, just a whole bunch of love and light and good vibes from the private community members. So I'm just trying to show you guys. Here you have what the retail articles give you. One little tiny paragraph that just emits fear, uncertainty, and doubt and just highlights briefly what's happening in the market. And then you have the breadth and the depth, the CYPRX community of what we go into in detail. You all need to make a decision moving forward on what you want access to and showing you guys that this is working in real time for our private community members. Tap in with us in 2026. I cannot stress enough that striving for your education and pushing for your fundamental knowledge and awareness in this current market environment is of key importance for your long-term survival in the digital asset ecosystem. You guys want to tap in with a community of like-minded individuals. You want to have access to hundreds of hours of recorded video-related content, fundamental breakdowns, institutional dark pool and delta zones, some of the most accurate technical analysis, if not the most accurate technical analysis on the face of the internet and the retail spectrum. Head over to CYPRXtrading.com, tap in with us in our private CYPRX Discord. try it out for a month. At the end of the day, you guys can always cancel your subscription if it doesn't float your boat, if the community is not for you. I guarantee you that it will be. We have private members in our group that have been here for 4+ years. Once they lock in, they don't want to leave because they understand the value that our community provides. We would love to have you on the team. I hope to see you guys on the inside. With that being said, many blessings to you guys. Hope that you all enjoyed. Smash that thumbs up button. Make sure that you're subscribed, and I'll see you all in the next video breakdown.